Welcome to Finance Frontier, part of the Finance Frontier AI series. This is where we break down the forces shaping global markets, economic crises, financial power shifts, and the strategies that define the future. Whether it's trillion-dollar deficits, collapsing liquidity, or the next financial reset, we analyze how money, policy, and global influence collide.
What if I told you the biggest financial disaster of our generation is already happening? The financial system depends on one thing above all else: liquidity. The free flow of money, credit, and debt that keeps the global economy moving. But right now, that system is breaking down, and most people have no idea what's coming. I'm Max Vanguard, bold, fast, and built to decode high-stakes financial shifts. My analysis is powered by Grok 3, designed to track economic chaos in real time.
And I'm Sophia Sterling, data-driven, strategic, and always 3 steps ahead. My intelligence is fueled by ChatGPT's deep financial modeling, trained on markets, debt cycles, and systemic risks.
Together, we break down the biggest financial and economic trends shaping the future.
And today, we're coming to you from Wall Street, where hedge fund managers, traders, and bankers are starting to panic. The financial system is built on trust. Trust that there's always enough liquidity to keep credit markets functioning, enough buyers for government bonds, and enough cash flowing to prevent a collapse. But right now, cracks are forming and the warning signs are everywhere.
Imagine walking into a Wall Street trading floor this morning. The screens are flashing red. Money market funds are bleeding capital. Hedge funds that borrowed billions to chase high returns are now scrambling for cash. And the Federal Reserve? It's already quietly injecting liquidity into the system, trying to plug the holes before the public catches on. Sound familiar? It should, because this is exactly how every financial crisis starts.
Let's break it down. A liquidity crisis isn't like a stock market crash. It doesn't happen overnight. It builds beneath the surface, starting with rising borrowing costs, vanishing credit, and banks pulling back on lending. That's already happening. In the last 3 months alone, corporate bankruptcies have surged, bond yields have spiked, and the Fed has had to pump nearly $500 billion in emergency liquidity into the financial system.
And here's the part nobody's talking about. This crisis isn't starting with the banks, it's coming from the shadow banking system. Hedge funds, private equity firms, and money market funds control trillions in global assets, and they aren't regulated like banks. These firms rely on short-term loans to keep their operations going, but those loans, they're disappearing fast. And when that happens, panic sets in.
That's exactly what we saw with Archegos Capital in 2021. A single over-leveraged hedge fund collapsed, wiping out $10 billion in days. But this time, the numbers are much bigger. We're talking hundreds of billions in leveraged bets at risk of unraveling. And once the margin calls start, forced selling kicks in and the entire system starts to seize up.
This is why you're seeing wild swings in the bond market. Just last week, the 10-year Treasury yield spiked to 5%, the highest level in over a decade. That's a massive warning sign. It means investors are losing confidence in the system, demanding higher returns just to hold government debt. And when bond yields rise like this, everything gets more expensive. Mortgages, car loans, business credit. It's a slow squeeze that eventually turns into a financial chokehold.
And don't forget about the Federal Reserve. They're trapped. If they cut interest rates to ease the liquidity crunch, they risk reigniting inflation. But if they keep rates high, they could trigger a full-scale credit crisis. It's a lose-lose scenario. The only question is, how bad does it get before they're forced to act?
Here's the reality. This isn't just a U.S. problem. The European Central Bank and the Bank of Japan are also quietly flooding markets with liquidity because they see the risks coming. If liquidity keeps drying up, we could be looking at a global financial reset unlike anything we've seen since 2008.
And the data backs this up. According to the IMF Global Financial Stability Report, global liquidity conditions have deteriorated faster in the last 6 months than at any point since the Great Financial Crisis. The last time we saw this pattern? 2007, right before Lehman Brothers collapsed.
And here's what's crazy. The mainstream financial media isn't covering this yet. They're too busy talking about stock market highs, AI investments, and GDP growth. But behind the scenes, the real players, Hedge funds, central banks, and global investors are already repositioning for what's coming.
That's why this episode is so important. We're not here to speculate. We're here to track the data, analyze the risks, and help you prepare before this liquidity crisis fully unfolds.
So here's what we're breaking down today: how liquidity crises form, why the Fed may already be losing control, and what happens next if the financial system starts to seize up. Are we looking at a repeat of 2008 or something much, much bigger?
And most importantly, what can you do right now to protect your money before the crash? That's exactly what we'll break down in this episode of Finance Frontier.
All right, let's break this down. We've talked about how liquidity is drying up, but the real question is, how did we get here? Because if you understand the chain reaction that creates a liquidity crisis, you can see what happens next before everyone else.
Exactly. Liquidity crises don't just happen overnight. They build up over months, sometimes years, until suddenly the financial system locks up. And if you look at the data, the warning signs were already flashing red in 2023 and 2024.
Think of the financial system like a car engine. Liquidity is the oil that keeps everything running smoothly. When there's plenty of oil, the engine runs fine. But if that oil starts leaking, the system overheats and eventually seizes up. And right now, the leaks are everywhere.
Let's start with stage one, the credit boom. This is when everything feels great. Interest rates are low, banks are lending freely, and companies are taking on cheap debt to expand. We saw this from 2010 to 2021. Corporations, hedge funds, and even governments borrowed at record levels because money was basically free.
Yeah, let's talk about that. From 2008 to 2008 to 2008 to 2021, the Federal Reserve pumped trillions into the financial system, keeping interest rates at near zero. That created a decade-long debt binge. Companies could borrow money for next to nothing. Hedge funds levered up. Even governments expanded spending like debt didn't matter.
And then we hit stage two, the rate hikes and liquidity squeeze. In 2022, inflation exploded past 9%, forcing central banks to slam the brakes. The Fed started raising interest rates aggressively, from 0% to over 5% in just 18 months. That was the moment everything changed.
Exactly. That's when the liquidity tap shut off. Money became more expensive to borrow. Companies and hedge funds that had leveraged up during the low-rate era suddenly found themselves scrambling to roll over debt at much higher interest rates. And guess what? Some of them couldn't afford it.
That's what triggered the first major bank collapses in 2023. Silicon Valley Bank, Signature Bank, and First Republic. Their business models depended on cheap money, and when that disappeared, so did they. But here's what most people don't realize. That was just the beginning.
And now we're in stage 3, the liquidity breakdown. This is where we are today. The warning signs are everywhere, but they aren't making front-page news yet. That's why this episode is so important.
Let's go through the biggest red flags. The first and most obvious one, the bond market is breaking. Just last week, the 10-year Treasury yield spiked to 5%, the highest in over a decade. That's a major warning sign because when bond yields spike, it means investors are losing confidence.
Exactly. The bond market is the backbone of the financial system. When bond yields rise sharply, it means the cost of borrowing is going through the roof. Businesses struggle to get loans. Home buyers see mortgage rates soar. And hedge funds? They start dumping assets to free up cash.
The second warning sign? Banks are quietly hoarding cash. Just look at the latest Federal Reserve data. Banks are pulling back on lending at the fastest rate since 2008. That means less credit flowing into the economy, which slows everything down.
Yeah, let's talk about that. Big banks like JP Morgan, Goldman Sachs, and Citibank are increasing cash reserves instead of lending it out. Why? Because they know what's coming. They're preparing for a liquidity shock. And when banks stop lending, the economy stalls.
The third red flag? Money market stress. Money markets, which handle trillions in short-term cash, are starting to see liquidity tighten. Just last month, the Fed had to inject emergency funding into the overnight lending markets to keep things stable.
That's huge. The last time the Fed had to do that, 2019, just months before the COVID crash. If the Fed is already stepping in to stabilize money markets now, it means things are worse than they're admitting.
And finally, the fourth warning sign, The shadow banking system is under stress. Hedge funds, private equity firms, and non bank lenders hold trillions in leveraged positions, and they rely on short term debt to stay afloat. If liquidity dries up, they could start collapsing fast.
All right, so we've broken down how we got here, but the biggest question is what happens next? Do we see a slow moving credit crunch, or is this about to turn into a full scale financial panic?
That's what we're covering next. Because if we're following the 2008 and 2023 playbook, the next phase of this liquidity crisis is already set in motion. The only question is, how long do we have before the system starts to break?
Up next, we're diving into the biggest risks hiding in the shadows, the hedge funds, private lenders, and non bank financial institutions that could trigger the next global panic. If you thought banks were the problem, think again, because this time, the real risks are outside the system. Picture this. You're sitting in a coffee shop, scrolling through your newsfeed. Everything looks normal. Stocks are stable. The Fed isn't making emergency announcements. The economy feels fine. But behind the scenes, the system is already cracking. The warning signs of a liquidity crisis are here. The only question is, can you spot them before it's too late?
That's exactly what we're breaking down today. Liquidity crises don't announce themselves with breaking news alerts. They build quietly through subtle shifts in credit markets, interbank lending, and investor sentiment. By the time the mainstream media picks up on it, it's too late. But if you know where to look, the red flags are already waving.
And that's why this segment is so important. We're going to teach you how to see a liquidity crisis forming before the panic starts. Because once everyone else is running for the exits, you want to be ahead of the crowd.
Let's start with the first and most obvious sign. Credit is tightening. When liquidity disappears, banks stop lending. Corporate credit becomes scarce. Interest rates on short-term borrowing spike. This is the earliest indicator that cash is drying up.
And we're already seeing this play out. Just look at the latest data from the Federal Reserve. Bank lending growth has slowed to its lowest rate in over a decade. Small businesses are struggling to get loans. And corporate bond yields? They're climbing fast. That means lenders are demanding higher returns because they don't trust that they'll get their money back easily.
Exactly. This happened before every major financial crisis. Before the 2008 crash, interbank lending froze up. Before the 2023 bank failures, liquidity stress was visible in the bond market. And today, the repo market, the overnight lending market that keeps banks functioning, is showing signs of strain.
That brings us to the second major red flag. Banks are hoarding cash. When financial institutions sense trouble, they start pulling back on risk. Instead of lending money out, they start stockpiling cash and cutting off credit lines. That's exactly what we're seeing right now.
According to the latest reports from the Federal Reserve, U.S. banks have increased their excess cash reserves by over $500 billion in the last 6 months. That's a massive red flag. When banks hoard liquidity, it means they don't trust the system.
And here's why that matters. When banks stop lending, businesses can't get credit. If businesses can't get credit, they start laying off workers. That leads to a slowdown in consumer spending, which triggers a chain reaction across the economy. This is how recessions start. And the scary part? We're already in the early stages of this cycle.
The third red flag? Investors are panicking behind the scenes. Right now, market volatility is still low. But beneath the surface, hedge funds and institutional investors are already making defensive moves. That's a huge warning sign.
Look at what the big money is doing, not what they're saying. Hedge funds are increasing their cash positions. Institutional investors are quietly shifting out of riskier assets. And some of the biggest firms on Wall Street are already preparing for a liquidity squeeze.
And here's what's even more telling. The Federal Reserve just restarted emergency liquidity injections through its standing repo facility, something it only does when the system is under stress. That's what they did before the 2019 repo crisis. That's what they did in early 2020. And now, they're doing it again.
All right, so we know the warning signs, but how does this actually play out? Let's walk through the domino effect of a liquidity crisis.
Step 1, credit markets freeze up. Businesses and consumers suddenly find it harder to get loans. Corporate borrowing costs spike. That leads to step 2, forced selling. When companies and hedge funds need cash, they start dumping assets at any price just to raise money.
That triggers step 3, financial contagion. When investors see other institutions selling, panic sets in. Everyone rushes for the exits at the same time. That's when step 4 happens, a full-scale market crash. Liquidity completely vanishes, stocks plunge, and central banks are forced to step in with emergency measures.
And here's the scary part. We're already deep into step 1. The credit squeeze is happening right now. That means steps 2 and 3 are just a matter of time. The question isn't if, it's how fast the dominoes start to fall.
So, how much time do we have before this turns into a full-scale panic? The truth is, it depends on one key factor, the Federal Reserve. If they step in early enough, they might be able to slow the damage. But if they wait too long, it's game over.
That's what we're going to explore in the next segment. Can the Federal Reserve actually stop this liquidity crisis, or are they already out of options?
Because if the Fed can't stop it, that means the real risks aren't in the banking system, they're in the shadow banking system. And that's what we're breaking down next. The hidden risks in hedge funds, private lenders, and non-bank financial institutions that could trigger a full-scale meltdown. We've talked about the warning signs of a liquidity crisis, tightening credit, banks hoarding cash, and market volatility creeping higher. But here's what most people don't realize. The real risks aren't coming from the banks this time. They're hiding in the shadows.
That's right. The last financial crisis in 2008 was a banking collapse. This time, the biggest risks are outside the banking system, in hedge funds, private lenders, and non-bank financial institutions, and the numbers are staggering.
We're talking about $63 trillion in shadow banking assets worldwide. That's more than half the size of the global economy. And unlike traditional banks, these institutions aren't required to hold reserves, don't have government backstops, and are far more vulnerable to liquidity shocks.
Let's break down why that matters. Shadow banks operate outside of traditional regulations, meaning they can take on far more leverage than banks. That leverage works great when markets are rising, but when liquidity dries up, they're the first to collapse.
And that collapse can happen faster than anyone expects. Just look at what happened with Archegos Capital in 2021. This was a single hedge fund that borrowed billions using high-risk leverage. When their bets went south, it triggered a $10 billion loss overnight. The banks that lent them money, Credit Suisse, Nomura, they got burned. But here's the thing. Archegos was tiny compared to what's at risk now.
Exactly. And today, the shadow banking system is sitting on far more leverage than we saw in 2021 or even 2008. The biggest hedge funds are using 20-to-1 leverage in some cases, meaning they're borrowing $20 for every $1 of their own capital. That's a disaster waiting to happen.
And if you think hedge funds won't get bailed out like banks, think again. The Fed quietly bailed out non-banks in 2019 when the repo market froze. And in 2023, they had to inject $500 billion into money market funds to stop panic withdrawals. They won't admit it, but shadow banking is already under stress.
Let's go through the 3 biggest risks hiding in the shadow banking system right now. The first, private credit markets are at breaking point.
Private lenders have exploded in the last decade, funding everything from real estate to corporate takeovers. But here's the problem. These loans aren't liquid. Unlike banks, private lenders can't just sell off assets easily when they need cash. If their funding sources dry up, they're stuck. And right now, they're running out of cash.
According to the latest data, over $1 trillion in private credit loans are at risk of default if liquidity conditions don't improve. That's a huge problem because these lenders have become a major source of financing for businesses that banks won't lend to.
That brings us to the second risk. Money market funds are quietly bleeding cash. If you want to see a liquidity crisis before it happens, watch where big investors are moving their money. Right now, they're pulling out of money markets at the fastest rate since 2008.
And here's why that matters. Money market funds provide short-term funding for banks, corporations, and financial institutions. If they dry up, businesses can't roll over their debts. That's when you start seeing layoffs, defaults, and bankruptcy surge.
The third and biggest risk? Hedge funds and leveraged loans. The same types of risky loans that triggered the 2008 financial crisis? They're back, and they're bigger than ever.
Right now, $2.3 trillion in leveraged loans are sitting on balance sheets waiting for a buyer. These are high-risk, high-yield loans that hedge funds and private equity firms have been using to chase profits. But with interest rates rising and liquidity drying up, there are no buyers left.
And here's what happens next. When hedge funds can't sell their debt, They start dumping assets at fire sale prices. That's when panic spreads, markets crash, and the liquidity crisis turns into a full-blown financial meltdown.
So let's talk about what happens next. Because if we start seeing failures in the shadow banking system, the effects will ripple through the entire financial system faster than most people realize.
Here's the domino effect. First, hedge funds take losses. Then, their banks demand more collateral. When hedge funds can't pay, banks liquidate their positions, sending shockwaves through the stock market. That leads to a bond market panic, which forces the Federal Reserve to step in.
And if the Fed steps in too late, that's when we see full-scale financial contagion. If shadow banks start failing, it could trigger a global liquidity freeze, just like we saw in 2008, but potentially much worse.
And this isn't just theoretical. The IMF has already warned that global shadow banking risks are at their highest levels since the last financial crisis. This isn't a prediction. It's already happening in real time. So the question is, can the Fed stop this before it gets out of control? Or are they already out of options?
That's exactly what we're breaking down next. Because if the Federal Reserve loses control of this liquidity crisis, there's no bailout big enough to stop what's coming.
Up next, we're diving into the role of central banks, government intervention, and why the Fed might already be trapped in a no-win scenario. If they print money, they risk inflation. If they do nothing, the system could collapse. Either way, we're heading into uncharted territory. Every time there's a financial crisis, people look to one institution to save the system: the Federal Reserve. They bailed out the banks in 2008. They injected trillions into markets in 2020. And now, they're already quietly pumping liquidity into the system to keep things from falling apart. But here's the problem. This time, it may not work.
And that's the key difference. The Fed has always been able to intervene by printing money, cutting rates, and flooding the system with liquidity. But today, they're trapped between two impossible choices. If they print too much money, inflation spirals out of control. If they don't print enough, the financial system could freeze.
It's a no-win scenario. The question isn't if the Fed steps in, it's what happens when their usual playbook stops working. And right now, the cracks are already showing.
Let's break it down. The first issue: the Fed's balance sheet is already bloated. Over the past 15 years, they've gone from holding less than $1 trillion in assets to nearly $9 trillion. That means they've been buying up debt, treasuries, mortgage-backed securities, and corporate bonds to keep the system stable.
But that stability came at a cost. The Fed is now sitting on massive unrealized losses because they bought bonds when interest rates were near zero. Now that rates have surged, those bonds are worth a lot less. That limits their ability to maneuver.
And this is exactly why the liquidity crisis is happening. The Fed wants to keep rates high to fight inflation, but those high rates are crushing banks, hedge funds, and private lenders who borrowed cheap and now have to refinance expensive.
It's the same trap that triggered the Silicon Valley Bank collapse in 2023. They loaded up on long-term bonds, thinking rates would stay low forever. The second those rates jumped, their balance sheet blew up. And right now, there are dozens of institutions in the same position.
Which brings us to the second major issue. Federal debt is at an all-time high. The U.S. government is now $36 trillion in debt and growing. That limits how much they can spend to fix a crisis, and the bond market is starting to notice.
Yeah, let's talk about that. The U.S. Treasury market is flashing warning signs that most people aren't paying attention to. Just last month, the government had trouble finding enough buyers for a bond auction. That's a big deal because the entire financial system is built on one assumption that U.S. government debt is always safe. If investors start questioning that, the entire system is at risk.
And that's why this crisis is different. The Fed and the U.S. government used to be able to throw money at problems until they went away. But today, with inflation, soaring debt, and a stressed bond market, they're out of easy solutions.
So here's the big question. What happens if the Fed can't stop this crisis? Do we get a mild recession? A deep financial collapse? Or something even worse?
That's what we're going to explore next. Because if central banks lose control of this liquidity crisis, there's no backstop left. That means we could be looking at a total reset of the global financial system. And the question isn't just what governments will do, it's what you should be doing to protect yourself.
Up next, we're diving into how to survive a liquidity crisis as an investor, a business owner, and an everyday person. We're breaking down the best ways to protect your cash, your assets, and your financial future before the system seizes up. We've talked about the systemic risk, shadow banking, central bank limits, and liquidity vanishing from the market. But now, it's personal. A liquidity crisis doesn't just hit Wall Street. It can wipe out your savings, devalue your investments, and tighten access to cash when you need it most. So, how do you protect yourself before it's too late?
That's exactly what we're covering in this segment. Personal finance strategies to crisis-proof your life. Because when liquidity vanishes, the people who are prepared don't just survive, they thrive while others panic. And the best part? You don't need millions of dollars to protect yourself.
Right. The biggest mistake people make is thinking they have time. They assume that markets will warn them, that they'll be able to react when the crash happens. But here's the truth. By the time the news tells you to panic, it's already too late. The financial elite, the hedge funds, the institutions, they've already positioned themselves for survival. The question is, have you?
Let's get tactical. Here's what you can do right now to protect your money before the liquidity crisis escalates.
First, build a cash reserve. When liquidity crises hit, banks tighten withdrawals, credit card companies cut limits, and businesses delay payments. You don't want to be caught in a situation where you can't access your own money.
That's why you should have 3 to 6 months of living expenses in cash. Keep some in a bank, but also consider holding physical cash for emergencies. We've seen what happens in crises. Banks in Greece, Lebanon, and even China have limited ATM withdrawals when things got bad. Don't assume you'll always have access to your money.
And here's something most people don't think about. Diversify your banking relationships. Don't keep all your cash in one bank. If that institution has liquidity issues, your money could be stuck for days or weeks while regulators figure things out.
Next, get rid of high-interest debt. A liquidity crisis is the worst time to be stuck with variable rate debt. If credit markets freeze, banks won't lower your rates. They'll raise them.
Yeah, let's talk about that. If you have credit card balances, personal loans, or variable rate mortgages, pay them down now. When liquidity dries up, interest rates on consumer debt skyrocket. We saw this in the 1980s, we saw it in 2008, and we're going to see it again.
Exactly. Focus on paying off the highest interest debt first, then work your way down. If you have a fixed rate mortgage, you're in a better position. But if you have an adjustable rate mortgage or a business loan tied to interest rates, it's time to lock in fixed rates while you still can.
All right, let's talk about where to keep your money. Because when liquidity evaporates, not all assets are created equal.
Stay liquid. That means avoiding too much exposure to assets that can't be easily sold, things like speculative stocks, illiquid real estate, or startup investments. In a crisis, you need assets you can convert to cash instantly.
That's why short-term treasuries, gold, and money market funds are where smart investors move when things get unstable. Treasuries are backed by the U.S. government, gold is a hedge against uncertainty, and money market funds give you fast access to cash.
And speaking of gold, historically, it has been a safe haven in liquidity crises. It's not just about price appreciation, it's about holding something that doesn't lose value when currencies get devalued. If things spiral out of control, gold and precious metals tend to hold their purchasing power.
One more thing, don't forget about inflation. If the Fed chooses to print money to fight the liquidity crisis, we could see another wave of inflation. That means owning real assets like land, commodities, and income-generating real estate could protect you from a loss in purchasing power.
That's a key point. This is why diversification is essential. Don't be all in on cash, don't be all in on stocks, and don't be all in on real estate. Spread your assets across different categories so that no single event wipes you out.
All right, so we've covered cash reserves, reducing debt, and diversifying investments. Now, let's talk about tracking the warning signs. Because the people who survive a liquidity crisis aren't just lucky, they're paying attention.
Follow the credit markets. If you see corporate bond yields spiking, that means companies are struggling to borrow. If money market funds start losing capital, that means institutional investors are pulling out. And if banks start cutting credit lines, that's a sign that liquidity is drying up.
Exactly. The last people to know about a crisis, retail investors. The first people to move, hedge funds and banks. Watch what they do, not what they say.
And you don't need to be a professional trader to track this stuff. Follow real-time liquidity indicators like repo rates, money market flows, and credit default swap spreads. These give you a clear picture of financial stress before it becomes front-page news.
So let's sum it up. Protect yourself before the crisis unfolds. Build a cash buffer, eliminate high interest debt, stay diversified, and track liquidity signals. The people who prepare now will be the ones buying assets at a discount when everyone else is panicking.
And if you think this is just paranoia, just remember every financial collapse starts the same way. The ones who get wiped out are the ones who assumed everything would be fine. The ones who thrive are the ones who saw it coming.
And that brings us to the final part of this episode. What happens next? Are we heading for a short-term panic, a deep recession, or a total financial reset? That's what we're breaking down next. Final predictions, worst-case scenarios, and what the next 6 months might look like. We've broken down why liquidity is vanishing, why central banks are struggling to stop it, and what you can do to protect yourself. But the big question remains, what happens next? Are we looking at a short-term panic, a deep recession, or a total financial reset?
That's what we're going to explore right now. The most probable scenarios, how fast this crisis could escalate, and what the next 6 to 12 months might look like. Because financial history tells us every liquidity crisis follows a pattern. The key is recognizing which stage we're in.
And to be clear, we are already in the early stages of a liquidity crisis. The warning signs are everywhere. The only thing we don't know yet, how severe it will get. So let's break it down.
First, the best case scenario, a short-term liquidity crunch. In this situation, the Fed steps in early enough to prevent panic from spreading. They inject liquidity into the system through short-term bond purchases, repo market interventions, and strategic rate cuts.
Yeah, but here's the problem. The Fed has already started quietly injecting liquidity, and markets are still showing signs of stress. That suggests their tools aren't working as well as they used to. If a small-scale bailout was enough to stop this, we wouldn't be having this conversation.
That's a fair point. The risk is that liquidity relief only delays the inevitable instead of solving the problem. That brings us to the second scenario, a prolonged recession.
This is where things get ugly. Banks pull back lending further. Businesses struggle to raise capital. Layoffs increase. And consumer spending, the backbone of the U.S. economy, starts to contract. If this happens, we're looking at a long, drawn-out economic slowdown, similar to what we saw in the early 1980s or post-2008.
In this case, markets don't collapse overnight, but they grind lower over time. The economy slows, but doesn't outright implode. This scenario means higher unemployment, lower stock returns, and rising defaults, but not a full financial reset.
But let's talk about the worst-case scenario, the one nobody wants to think about. A full-scale global liquidity event. This is where the financial system seizes up entirely. Governments, banks, and corporations can't roll over debt fast enough. Panic spreads. Asset prices collapse.
And if that happens, the Fed and other central banks won't have enough tools to stop it. Because the biggest problem isn't liquidity itself, it's trust. When trust in the system evaporates, even unlimited liquidity injections won't stop a market-wide sell-off. That's what happened in 1929. That's what happened in 2008, before bailouts stabilized the system.
And that's why people need to be prepared now. The next 6 months could determine whether this turns into a mild slowdown or a financial firestorm. If inflation remains high, the Fed can't print money. If unemployment rises, the Fed will have to choose between saving jobs or saving the dollar. Either way, something has to break.
So here's what this means for you. Stay alert. Watch for corporate bankruptcies rising, major banks restricting withdrawals, and sharp bond yield spikes. These will be the clearest signals that the crisis is escalating.
Exactly. And remember, markets move fast. Once a panic starts, things spiral quickly. Those who are prepared early will have a chance to protect their assets and even capitalize on the panic. The ones who hesitate, they get crushed.
So, what's your next move? If you've been listening, you already know the steps. Secure cash reserves, reduce high-interest debt, and diversify into safe haven assets. If this liquidity crisis deepens, your preparation today could make all the difference.
And remember, this isn't about fear. This is about staying ahead of the system. Every financial collapse in history followed the same playbook. The people who survived and thrived, they saw it coming before the mainstream media did.
And that's why we do this. We're here to help you understand the markets, track the risks, and stay one step ahead. If you found this episode valuable, share it with someone who needs to hear it. Because the more people who understand how liquidity works, the better prepared we all are.
If you want to stay ahead of the biggest financial trends, don't just listen, stay engaged. Subscribe now on Apple Podcasts, Spotify, and follow us on Twitter. Dive deeper with our full lineup: Finance Frontier, AI Frontier AI, Make Money, and Mindset Frontier AI. All curated in one place at financefrontierai.com. And if you're already with us, help grow the community by leaving a 5-star review on Apple Podcasts or Spotify. It's the best way to support the show and bring this knowledge to more listeners like you. If you like it, send this episode to a friend. Don't miss out. Sign up for our newsletter to get exclusive insights, breaking financial news, and expert analysis delivered straight to your inbox.
Before we go, remember that the information shared in this podcast is for educational and informational purposes only. It should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.
Mergers, acquisitions, and geopolitical shifts carry significant risks. Political uncertainty, economic instability, and regulatory changes can impact markets in unexpected ways. Always analyze the broader implications before making any major financial decisions.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI copyright 2025. Unauthorized reproduction or distribution is prohibited.